Welcome back to the channel, everyone. Today I want to talk about GameStop's stock split. I want to talk about how this could impact AMC and how this could cause a share recall, which will cause the mother of all short squeezes in all meme stocks. So stay tuned and let's make some money. Now, I think there's tons and tons to unpack here. GameStop have just announced a stock split and a dividend. The stock split could cause a share recall, which means the shorts would have to buy back the shares they've shorted and return them, which would obviously cause those shorts to be liquidated and cause the MOASS. So now I want to dive straight in with the key information. So, Unusual Whales just tweeted saying breaking news. GameStop split confirmed in their 8K report via a dividend. In GameStop's recent 8K, under the Other Events heading, it says that GameStop has just requested an increase in the number of authorised shares of Class A common stock from 300 million shares to 1 billion shares. It says in order to implement that stock split of the company's Class A common stock in the form of a stock dividend and provide flexibility for future corporate needs. This means that GameStop aren't doing a share issue and just issuing another 700 million shares on top of their existing 300 million shares. It means they're doing a stock split, which involves recalling the 300 million shares and issuing 1 billion brand new shares. The definition of a stock split per my accounting course is a stock split, also called a forward stock split, occurs when a corporation recalls its outstanding shares and issues more than one share for each previously outstanding share. Now, I don't know the exact fine details here because it doesn't say that they're recalling their 300 million Class A shares and issuing 1 billion new Class B shares. I think what they're actually doing is just splitting their Class A shares through a dividend and therefore not necessarily replacing one kind of share with another kind of share. Therefore basically meaning that you don't have to return all of the shares that you currently hold on your trading platform or whether you've DRS'd the shares, but GameStop are just going to issue more shares on top of that during the split. Now, those additionally issued shares don't go up for sale, they get given directly to you in your trading account or on your computer share platform. Now, obviously this is going to impact AMC because if GameStop squeezes, then AMC will also squeeze as well. In addition, I think a number of people are now getting in contact with Adam Aaron to see if Adam can perform a reverse split. So Adam wouldn't necessarily split the AMC stock and turn the 513 million shares into 1 billion or 2 billion shares. He could actually decrease the number of shares in issue from 513 million back down to say 100 million shares, for example. Now again, I think we've got a lot to unpack here. We've got a dividend, we've got a potential share recall and a potential share recount on top of that. So I want to break them down one by one. Falcon tweeted saying, whew, okay, apes caught a dub today. GameStop just announced a stock split along with a dividend. Why? Let's discuss. And he says, so GameStop and pet food connoisseur Ryan Cohen probably had a large say in this, but GameStop just announced a 3.3-for-1 stock split, along with offering a to-be-decided dividend. Why to be decided? We'll cover that in a second. Now, obviously, GameStop didn't announce exactly how much they're going to pay for the dividend, whether it's 50 cents per share, 10 cents per share, $1 per share, or some kind of other form of dividend, like an NFT dividend. And he says, so what is a dividend? A dividend is paid out each quarter or every half year or once a year, and is usually a set ratio of the stock price that is paid out to investors in the form of additional shares, warrants, or just straight up cash in your accounts. Now again, right here in 2022, we had other forms of dividends as well, like an STO or a security token offering, or an NFT dividend, which would be the gifting of an NFT to you, the shareholder. And he says dividends are a reward for shareholders continuing to hold the stock, which is obviously good for the HODL movement, as people will continue holding their GameStop and AMC shares for the promise of a dividend. And I think Mike M very importantly suggests who pays the dividend on a naked share. Here we go, ladies and gentlemen. Obviously, during GameStop's dividend, they are only going to pay dividends on their currently existing 300 million shares. Obviously, GameStop aren't going to pay dividend on those synthetic shares that have been created by the market makers and sold to unsuspecting retail investors and potentially other institutions like you and I. And obviously that means that market makers like Citadel are going to have to cough up a dividend on every single synthetic share that they've issued, which obviously right now could be in the realm of billions of synthetic shares. Right now, GameStop has around $2 billion in liquid cash. $2 billion divided by 300 million shares is a potential dividend of up to $6 per share. $6 per share multiplied by 2 billion synthetic shares, which is a potential estimate on the number of synthetic shares, is a total dividend that Citadel would have to pay to GameStop shareholders of over $13 billion. But now the really interesting part here is if Ryan Cohen issues a dividend in the form of shares. Let's say Ryan Cohen doesn't issue a $1 per 1 share dividend, he issues a dividend of 3 shares for 1 share. Guys, if you didn't already know, Moomoo and Futu have just officially announced that Futu does not accept payment for order flow, and therefore you don't have to worry about your shares going through sketchy dark pools or being given to Citadel. Right now you can currently get 5 free stocks valued up to $3,500 each when you sign up to Moomoo using the link in the description below and make your first deposit. Moomoo also won the award for Best Trading Platform at the FinTech Breakthrough Awards. Moomoo is also entirely commission free, has tons of technical indicators and advanced charting tools. Moomoo publishes daily short selling data, position cost distribution and much more. Moomoo is also incredibly easy to use and is very customizable and will help you to trade like a pro. So guys, be sure to sign up to Moomoo using the link in the description below to get up to $17,500 in free shares. Now obviously this would be part of the actual stock split. If you're currently holding 1 share in GameStop, Ryan Cohen will gift you an additional 3 shares as part of the dividend. But in terms of how that impacts naked shares or synthetic shares, obviously these market makers would have to go into the market and buy 3 shares for every single 1 synthetic share that they've issued. Now obviously that's not actually going to be possible because it would mean that Citadel have to go into the market and potentially buy 6 billion shares for GameStop and give those to investors that are holding the synthetic shares as a gift. But obviously Ryan Cohen is only issuing 700 million shares and those shares are going to go to current GameStop shareholders. And therefore, basically the market makers can't gift a share as a dividend to synthetic shareholders. Long story short, basically meaning those market makers have to cover their synthetic shorts before the dividend is issued. Now obviously these market makers can't issue a cash dividend if Ryan Cohen has announced a share dividend, basically meaning that these market makers will have to cover their synthetic shorts and delete the shares that they created. Obviously these market makers covering those synthetic shorts and deleting those shares would cause the short squeeze and they would end up being liquidated. And obviously on top of that, if GameStop does recall their shares and issue those new shares instead, again that will also cause the short squeeze because those massive lenders like BlackRock and Vanguard will be forced to recall all of their lent out shares. Obviously if BlackRock and Vanguard and all those ETFs recall those shorted shares, it means those shorts have to cover their short positions and return the share. And again, obviously for those shorts to cover their short positions, they have to buy GameStop shares in the open market and return them. Now again, this also impacts AMC because if GameStop squeezes, then AMC will likely also squeeze as well. And on top of that, there's nothing that prevents Adam Aron from issuing the exact same dividend that GameStop are issuing right now. Obviously AMC does currently have negative cash reserves and obviously a loss reserve, but it won't be long until AMC is in a profitable position and will be able to pay those dividends as well. Now I think this expert drawing from Trey's Trades really depicts exactly how Ryan Cohen is feeling right now. Now you may have already seen some negative mainstream media response, such as a response from Jim Cramer. He said GameStop with a split. Can you imagine how high the stock would actually go if they had a strategy? Now obviously I do think that Ryan Cohen absolutely does have a strategy. Mainstream media like Jim Cramer is just trying to discredit him. But as Stonks Batman says, he's trying to prevent FOMO. Obviously Jim Cramer doesn't want AMC and GameStop to squeeze because otherwise it will liquidate him and all of his hedge fund buddies. The SEC were also trying to prevent FOMO as well, and Stonks Batman says it makes sense now. Now obviously FOMO and gamma squeezing is exactly what we need for GameStop and AMC to have their next leg up and continue their run and potentially cause the squeeze. Now I also want to talk about exactly what happens when these shorts cover and end up being liquidated during the squeeze. Joel says shorts can't afford to cover all of the synthetics for GameStop. It's a doomsday scenario for them. You can't short AMC if you're bankrupt as well. And he says if one meme squeezes, then MULN, BBIG, HYMC, and likely 2 or 3 or 4 of them also end up squeezing as well. He said obviously there's not enough cash on the planet to pay for all of these shorted shares if they end up squeezing to thousands and thousands of dollars per share. Now here we have a very crude drawing of some scales. Obviously at the moment these scales are showing that the hedge's margin or their account value is currently positive. Now obviously we know that Citadel has or had around $234 billion worth of assets. But obviously that is the face value of these assets or their cost price, and these assets may no longer be worth that amount of money. Obviously in that $234 billion position, they have some stocks like Tesla, Google, Apple, maybe Microsoft and many others that they've been holding for a long period of time, and they probably have a lot of unrealized gains on those stocks. But what they also have is a ton and ton of synthetic shares and naked short positions and legit short positions as well on Gamestop and AMC, which is obviously dragging their portfolio value down. After Gamestop and AMC ran up so much, obviously the value of their total short position decreased significantly, but at the moment their total account value is still in the green. Let's say you started by shorting AMC with $10,000. You have a cost price of $10,000 for your AMC short position, but after the January and June run-ups, maybe your $10,000 short position is now only worth around $1,000. Obviously, you would have had to average up during that short position and potentially add additional cash and additional margin to that short position to ensure that it didn't end up going negative and end up being liquidated. But obviously, for example, at the moment, these hedges do currently have a positive account value. However, it is close to being a net nil value as they are only just surviving. Obviously, as these scales move downwards and their account value ends up hitting zero, they end up being liquidated as the value of their assets no longer outweighs the value of their liabilities. Now, obviously, when their account value reaches zero and they end up being liquidated, a third-party firm of accountants will be employed to ensure that all of their long positions are sold off and all of their short positions are covered as well. Now, obviously, at that very moment where their account value reaches zero, they will be forced to cover their shorts. Maybe their account value reaches zero when AMC hits $200 per share. Obviously, it's going to be different for every single hedge fund out there. Some will be liquidated at 40, some at 60, some at 80, some at 100, some at 200, and some maybe even higher. But obviously at that point when they get liquidated, they will be forced to cover all of their short positions, and there's basically going to be a market order that's placed to buy enough shares to cover off their short position. Now, I guess it all really depends whether us, the AMC apes, want to sell our shares at that value that they end up being liquidated at. Obviously, if they place a market buy order and their market buy order isn't entirely filled because the apes don't want to sell their shares at that price, they technically won't have enough money on their own to continue buying AMC shares. Remember, they get liquidated as soon as their account value hits that 0.00 mark, and therefore they can only afford to buy and cover their position at exactly that AMC price without the price running up. Obviously, if Citadel places a billion share buy order for AMC, it is not going to be entirely filled at one specific price point because many apes don't want to sell their shares for $100 or $200 per share. Now, obviously, at that point, that is exactly when the DTCC need to get involved, because obviously if Citadel end up defaulting, all of the remaining members in the DTCC are responsible for Citadel's debt. And that is exactly when the $60 trillion insurance policy, aka the $60 trillion of assets held by the other members of the DTCC, kicks in. Because then all of these other members of the DTCC have to give money to Citadel to ensure that Citadel can buy back all of their shares in the open market from us, the AMC apes, at the prices that we decide to sell at. Now, obviously, as I mentioned in my video the other day, it's likely that a number of apes won't sell their shares for reasonable prices, or so-called reasonable prices, and therefore it's likely the Fed will have to get involved as well and create some form of settlement between the apes and the hedge funds. I am personally super excited to see GameStop stock split and their issue of a dividend. Guys, be sure to let me know down in the comments below whether you think this will end up causing the short squeeze. And as always, guys, if you enjoyed that video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.